Hi everyone, so today we're going to do Swingalong Limited and we're going to do the first part of this question during this video. So, the required asked you to prepare the following journal entries, cash transactions included, relating to the above mentioned information in the General Journal of Swingalong Limited in accordance with IFRS. The lease cutting machine for the year ended 31 December 2017 and the lease of hammer drills for the year ended 31 December 2018. So we know we are going to do two sets of journals, one for 2017 of the cutting machine and one set of journals for 2018 for the lease of the hammer drills. In the note, they tell you that journal narrations are not required. Also, to round all calculated amounts to the nearest R1, round all percentages to 2 decimal places, and indicate the component of the financial statements affected. Okay, so that's very, very important. And journals must be dated. Okay, also very, very important. So after reading the required, you can go and read the information. The approach I followed was as follows. I used two different color highlighters to highlight the cutting machine and the hammer drills so that I know specifically which information relates to which. Also, write a word next to each paragraph so you know what it is about. And decide what information you are going to use in your calculations. And only highlight the important information. Do not highlight the information that you are not going to use. So, as I've said, my highlighting looks as follows. I used green for the lease of the cutting machine. Okay, I only highlighted the important information. Then I used blue to indicate things that specifically relate to the lessor so that I don't get confused between the amounts of the lessee and the lessor, because those that I get for the lessor is used to calculate the interest rate implicit. Then I used pink for the lease of the hammer drills, okay? And then I used yellow to highlight any other information as well as the required. And at each paragraph, I indicated what the paragraph is about. I'm now going to start with the first part of the question with regards to doing the journals for the 2017 year of assessment of the lease of the cutting machine. So now I'm going to read through all that information. So after reading the information, we now know the following. On 1 January 2017, it was the commencement date of the lease of the cutting machine, and the lease is for a non-cancelable period of 5 years. And on 1 January, we paid a deposit of 50,000 Rand. So that is very, very important. We'll get to that later. Then also the external legal advisors of Swingalong Limited were involved in the negotiations of this contract from 30 November until 15 December 2016. The invoice dated 15 December 2016 received from the legal advisors amounted to 5,000 Rand and was paid by Swingalong Limited on 15 February 2017. So that is very important because 15 February 2017 is within the period we have to do the journals for. You can ignore the time value of money. Swingalong Limited correctly accounted for this transaction in terms of IFRS 16 leases in 2016 by classifying and recording these costs as initial direct costs. So that part is very important because it already indicates that they did the journal entry for these initial direct costs in the 2016 year. Okay. Then the rest is about the payments. So payments for this lease is payable biannually in arrears. Each lease payment amounts to 148,000 in total, and also Cutting Edge Limited will annually provide a maintenance service on this cutting machine. 2,500 Rand of the total lease payment relates to this maintenance service, and Swingalong Limited established that similar maintenance services are provided by third parties for 6,000 Rand per year. Okay, so I'll talk about that in a while to know what information there is very important. They also tell you that the first lease payment was paid by Swingalong Limited to Cutting Edge on 30 June 2017. The lease also contains a purchase option that will enable Swingalong Limited to purchase the cutting machine at the end of the 5-year lease term for 700,000. If Swingalong Limited does not exercise this purchase option, Cutting Edge Limited anticipates that it will be able to sell this cutting machine for 850,000 at the end of the lease term. no guarantee has been provided to Cutting Edge Limited that this amount will indeed be realized. And on 1 January 2017, there was no reasonable certainty that Swingalong Limited would exercise this purchase option. Okay, so what's important there especially is that they will not exercise the purchase option, okay, because they don't think that they will benefit from it. Then Swingalong Limited does not own other cutting machines, etc. So this paragraph is about IAS 16, and it tells you that the cutting machine has an estimated remaining useful life of 15 years. Okay. And then also the agreement does not stipulate any residual value guarantee with regards to this cutting machine. So there's no residual value guarantee. Then in terms of the lesser, so Cutting Edge Limited incurred initial direct costs of 7,000, and the fair value of the cutting machine on commencement date of the lease is 1.5955 million rand. So after I read the information, I drew my timeline, and this is what it looked like. So I know my commencement date is 1 Jan 2017, and I know the question asked me for the journal entries for the 2017 year of assessment alone. So this is this portion here in the blue. Okay. Then I know that we already did the journal entry for the initial direct cost before 2017 year of assessment, but we are paying that amount during February of 2017. So we know we have to go and do that journal. And we know that the payment amount consists of a non-lease component and a lease component. Also, on the commencement date, we know we have to go and do our initial journal entries where we recognize the lease liability as well as the rights of use asset. For the lease liability, we know we are going to use the interest rates implicit. And this is because in the information at the end, they told you that they gave you the incremental borrowing rate, but they told you that Swingalong Limited has all the above information of the lessor. They have all that information, which means they can go and calculate the interest rate implicit. And the standard tells you that you should first go and use the interest rate implicit where possible. Otherwise, if you can't calculate it, then you go and use the incremental borrowing rate. And that is why here we can calculate the interest rate implicit, so we know we are going to use that rate. So that is why the lessor information is very important, because that is what you use to calculate the interest rates implicit. And then also we know the lessee information is then used to calculate the lease liability as well as the rights of use asset. Okay, and also the payment date, so the second payment of each year coincides with the year end, so we know we don't have any accrued interests, which makes the journals much easier. So our first step is going to be calculating the interest rate implicit, because we need to calculate that in order to calculate our lease liability, because we want to calculate it and the right of use asset so that we can do our initial journal entries on 1 January 2017. So the interest rate implicit is calculated from the perspective of the lessor. The PYR is the payments per year. Your future value is your guaranteed residual value plus any unguaranteed residual value and plus any purchase option. The N is the period of the lease, so like the number of payments. The payments is your fixed lease payments and your variable lease payments that are dependent on an index or rate. The present value is then the fair value of the asset plus any initial direct costs of the lessor. Okay, minus a deposit received, okay, because a deposit is not financed and can therefore not be part of your interest rate implicit, because there will be no interest on the deposit because the lessor already received it. Okay, so for the future value, in the information they told you the following. The lease contract contains a purchase option that will enable Swingalong Limited to purchase this cutting machine at the end of the 5-year lease term for 700,000 Rand. If Swingalong Limited does not exercise this purchase option, Cutting Edge Limited anticipates that it will be able to sell this cutting machine for 850,000 Rand at the end of the lease period. no guarantee has been provided to Cutting Edge Limited that this amount will indeed be realized. And on 1 January 2017, there was no reasonable certainty that Swingalong Limited would exercise this purchase option contained in the lease contract. Okay, so because they tell you that there is no reasonable certainty that Swingalong Limited will exercise it, then you don't take the purchase option into account in your future value. Also, they tell you that if there's no purchase option, Cutting Edge Limited will sell the asset for 850,000 Rand and no guarantee has been provided. That is why this 850,000 is your unguaranteed residual value. You know that the unguaranteed residual value is part of your future value when you calculate your interest rate implicit, because the lessor will receive this 850,000 Rand at the end of the lease period, but not from the lessee, but from another party. So your PYR is 2 because you have 2 payments per year. Your future value is the unguaranteed residual value of 850,000 Rand. N equals 10 because the lease period is 5 years and you have 2 payments per year. So 2 times 5 is 10. The payment is then only the lease payment. So we know that this 148,000 consists of the non-lease component and the lease component, and we should go and remove the non-lease component. They tell you that the maintenance cost has a standalone price of 6,000 Rand per year. So that is why you take the 6,000 divided by 2 to get a payment of 3,000 Rand per 6 months. Okay, because that is the payment period with which you work. The standard tells you that you should take the standalone selling price. And that is why you take the 6,000 and not the other amount that they give you. The present value is then the fair value of the asset at the date of the commencement of the lease, minus the 50,000 Rand deposit, plus the 7,000 initial direct costs of the lessor. And this then gives you an I of 11.78%. So now we have the interest rate implicit, and we can go and calculate the lease liability. The lease liability is calculated from the perspective of the lessee. The future value for your lease liability equals the amounts expected to be payable under the residual value guarantee, plus any purchase option. Let me make this clear. This amount payable under the residual value guarantee is not the residual value guarantee. It's the amount the lessee will pay under the residual value guarantee, which is the difference between the residual value guarantee and the fair value that the lessees estimate. Okay, the payment is then also equal to the fixed lease payments and any variable payments that are dependent on an index or rate. The N is the period of the lease, so the number of payments, and then the I, we calculated that as the interest rates implicit. So your PYR is 2, the N is also equal to 10 years because it is 5 times 2. Future value is 0 because there's no payment under the residual value guarantee because there is no residual value guarantee. And they are not going to exercise the purchase option, so the future value is 0. The payment is the 145,000 because it excludes the maintenance component. So this is done just like we did in the interest rate implicit. The I is the interest rate implicit, and you get a PV of 1072797. So on commencement date of the lease, we also know that we have to go and record the right of use asset. So the standard tells us that the right of use asset is the amount of the initial measurements of the lease liability. So that is the present value you've calculated, and any lease payments made at or before commencement date, less any incentives received, any initial direct costs by the lessee, and any estimates of costs to be incurred by the lessee to dismantle, remove, or restore the asset that has been leased. So we already calculated the lease liability. Also, the deposit of 50,000 Rand forms part of your right of use asset, as this is a lease payment made at commencement date. So, our initial direct cost of the lessee of 5,000 Rand also forms part of the right of use asset. So, we get a total right of use asset of 1,127,797. However, remember, the initial direct cost that the lessee paid of 5,000 Rand was already recorded as part of the right of use asset in 2016. Therefore, we are not going to do the journal to capitalize that to the right of use asset. But it was paid during February of the current year, and therefore we are going to do that journal. So, the journals on 1 January 2017 will look as follows. We would debit right of use asset cutting machine with the amount of the lease liability, and we would credit the lease liability with the same amount. We would then debit the right of use asset cutting machine with a 50,000 Rand deposit and credit your bank because you paid the deposit on 1 January 2017. Then, on 15 February 2017, we would go and record the payment of the legal fees or the initial direct costs of the lessee. So, that would be a debit accrued legal fees and credit bank. Because in 2016, when we capitalized the 5,000 Rand to the right of use asset, it hasn't been paid yet, and that is why the credit leg on that date was your accrued legal fees. Okay, so on 15 February 2017, you now do the journal entry for the payment. So now we did the journal entries for the commencement date, 1 January 2017, as well as the date that the initial direct costs were paid. So the next date journals that we need to do is 30 June, which is the date of the first payment. The standard tells us that we should go and do a journal entry for the interest that is accrued up until the date of the payment, which is the interest from 1 January 2017 to 30 June 2017. Then we should also go and do the journal entry for the payment on 30 June. The interest is calculated as follows. You take your calculator on which you calculated your lease liability. You then enter one input interest because the 1 represents your first period of your lease, which is 1 January 2017 to 30 June because you used the PYR of 2. So you work in periods of 6 months. So 1 input interest is then equal to interest of 63188, and that is why you do the following journal entry. You have debit interest expense and credit lease liability because the interest expense increases your lease liability. Then you have to go and do the journal entry for the payment that you've made. As we've said, you have a non-lease component and a lease component, and the standard tells you that you have to go and record it separately because the non-lease component is not part of the lease liability because you did not elect any practical expedient. So the non-lease component is calculated as the 6,000 Rand standalone selling price of the maintenance expense divided by 2 because the 6,000 is for an entire year and you are working with periods of 6 months, and that gives you 3,000 Rand per 6-month period for the non-lease component. The lease component is then the remaining payment, which is the total payment of 148,000 minus the 3,000 non-lease component, which gives you 145,000. So for the payment journals, you do the following. You debit your lease liability with 145,000 and credit bank because this payment then reduces your lease liability as you paid this amount. The maintenance expense is then debited and then you credit the bank because this is also an outflow of cash. Now we did the journal entries for the first payment. So now we should go and do the journal entries on 31 December, which is your year end, as well as the date of your second payment. So as we've done previously, you should go and do the journal entry for the interest that is accrued up till this point, as well as the payment that you've made. So the interest for this period is calculated as 2 input interest because this is your second period, which is 30 June 2017 to 31 December 2017. And that gives you an interest of 58369. And that is what is then recorded in the same way as we did on 30 June 2017. Then the payments is also done in the same way. You again debit the lease liability with 145,000 and credit the bank. The maintenance expense is debited with 3,000 and you credit bank with 3,000 as well. At each year end, we have to go and do the journal entry for the depreciation of the right of use asset. So how we calculate that is we take the right of use asset that we've calculated at the commencement date and we divide it by the lease period, because this is the time you would use the asset. The only time where you divide it by the useful life of the asset itself is when you elect the purchase option or if ownership transfers at the end of the lease. But in this case, there was no purchase option and the ownership does not transfer, and therefore you divide it by the lease period of 5 years. So that gives you the depreciation for the year. You debit depreciation and credit the right of use assets cutting machine. I'm now going to discuss the lease of the hammer drills and go through that information. In the information, they tell us that Swingalong Limited entered into a non-cancelable lease agreement with Blue and Pecker Limited on 1 January 2017. Very important, remember, for the lease of the hammer drills, they ask us for the journal entries for 2018. Okay, to lease 2 hammer drills, low value asset. So that's also very important because then you can go and apply the recognition exemption, okay, for a period of 3 years. The lease does not include any option to terminate the lease, and ownership of the hammer drills does not transfer to Swingalong Limited at the end of the lease term. Also, in terms of the payments, they tell you the following lease payments are payable annually in arrears, with the first payment payable on 31 December 2017. And then they give you the lease payments per hammer drill per year. They also tell you that there's an option to extend the lease for a further 2 years. And during those 2 years, the annual lease payments will amount to 1,500 per hammer drill per annum. At commencement date of the lease, management of Swingalong Limited believed that there would be significant economic incentive to extend the lease for the additional 2-year period. And therefore, because they tell you that they have significant economic incentive to extend it, then it is probable that they will extend the lease. And now you have to take those 2 years into account in this lease. Okay. The next part is also very important, where they tell you that Swingalong Limited elected to apply the recognition exemption. So this means that you are not going to recognize a lease liability or right of use asset at the commencement date of the lease. You are going to recognize a lease expense over the lease period using the straight line method. Then Swingalong Limited incurred and paid legal fees of 2,000 Rand associated with this contract on 1 January 2017. Very important. This legal cost has been incurred on 1 January 2017, so it's not part of the 2018 financial year that is required of you to do the journals. So you won't do any journal for this legal fees. Okay. So let's go and do the calculations. Now that I've read the information, I can go and draw my timeline. So I know that the lease started on 1 January 2017, but the journals are required for the 2018 financial year. It is a low value asset and they elected the recognition exemption. So I have to go and calculate the lease expense per year. Okay, so, and also we elected the extension option. So that is why we also have to add the additional 2 years of the lease. Okay. So what we do is we know we got the rental per year and we multiply that with 2 per year because we have 2 hamadrolls and they gave us the amount per hamadroll. Okay, so then we add all those amounts together and divide it by the lease period of 5 years to get a lease expense per annum of 4,900 Rand. Okay, so this is our lease expense per year because we chose to apply the recognition exemption. So now we can do the journal entries for the 2018 year of assessment. So we debit the lease expense with 4,900 Rand because this is the lease expense we have calculated per annum. Then we can credit bank with 6,500 Rand because in 2018, this is the amount that you actually pay for the lease. Then this 1,300 Rand accrued lease expense that you eliminate comes from the 2017 year of assessment. So in 2017, you would have done the following journal entries. You would have debited lease expense with the 4,900 Rand because this is the lease expense you've calculated using the straight line method. You would have credited bank with 3,600 Rand because in 2017, this is the amount that you actually pay. The balancing amount is then credit accrued lease expense, which is a balancing figure of 1,300 Rand. This is because you only paid them 3,600 Rand, while the lease expense is actually 4,900 Rand for the period, meaning you've paid them less than what you owe them. So that then gives you accrued lease expense, which is a liability of 1,300 Rand. This 1,300, you will pay them that in the next payment, which is then in 2018. And therefore, this 1,300 forms part of the 6,500 that you receive, that you pay in 2018. So that means you don't have an accrued lease expense anymore in 2018 and you have to eliminate it against the payments. And that is why you debit accrued lease expense with the 1,300 because you do not have it anymore as you've made that payment now in the 2018 year. The balancing amount is now the 300 Rand prepaid lease expense. So in 2018, you paid them more than what the lease expense is for the year. And that is why it is prepaid lease expense, which is an asset.